Hello and welcome to the Investing on the Go podcast by FundCalibre. I'm Ryan Lightfoot-Brown and I'm talking today with Alessandro Dicorrado, one of the fund managers on the 91 Global Special Situations Fund, formerly known as the Investec. Alessandro, thank you very much for your time.
Pleasure.
Now, you're a value investor and you look for sort of 5 different types of value stock. Can you perhaps sort of talk us through those 5 different ideas and maybe give an example for each one?
Yes, of course. The general idea of what we try and do is that we try and use the provisional or temporary uncertainty created by economic or market events to buy mispriced stocks. And the first bucket that we like to talk about is what we call fallen angels. And these are businesses that have been in great favor with the market at some point in the past and really have excellent businesses. So there was a time, for example, in 2011, 2012, where we owned Microsoft in this group of businesses. But at the time, Microsoft was defined as a tech dinosaur, and people thought that Google and Amazon were going to steal its lunch. And you could buy the company on around 10 or 11 times earnings, which is a very, very low valuation for a company like this. And of course, that's been one of our most successful investments. We don't own Microsoft anymore, but it did very well for some time. And currently we own American Express in this bucket. But basically here we try and buy those amazing businesses, great franchises, when the market temporarily doesn't think that they are such great franchises. The second bucket we'd like to talk about is what we call cyclical leaders, which are those companies which are economically sensitive, but really otherwise have businesses that are just as attractive as the franchises or the businesses that we described in our fallen angel bucket. And what we do here is we wait for the cycle to go out. You think about, for example, an industrial business. We wait for the economic cycle to go out, and then we just buy the best business in a certain industry. And what that does is if you buy the best, it's normally not the absolute cheapest, but if you buy the best, it means they can continue to invest. It means they have the best technology, the best balance sheet, and really over time, it really pays to buy the best company in the sector rather than try and buy the absolute cheapest. Now, the major pushback we get from clients when we do that is that the question is, are you not worried about the market falling further? And really, if you take a long enough horizon when you invest, you don't have to worry about not picking the absolute bottom in a stock. You can buy a little bit earlier. And then we have hidden assets and special situations, which I'm going to do together. And really, these are companies that have very specific value catalysts, let's say, although we don't particularly like to use the word catalyst, but we have a very specific value catalysts to unlock the value that is temporarily hidden from the market. So a special situation might be a spin-off or a post-bankruptcy, a company that's just emerged from bankruptcy where you have a lot of stigma about investing in it. Or you could have a company that has that looks like one thing, but really has one division that does something very, very valuable and which investors are temporarily ignoring. And then finally, we have what we call deep value, which are companies that are unremarkable from a returns perspective or business perspective, but we really try to buy them absolutely bombed out. And there is a space for that. Although if we had our ideal portfolio, we probably wouldn't have to fish in that pond. But sometimes opportunities are thrown out there as well.
Thank you. And stock market's obviously fallen very dramatically recently due to the coronavirus crisis. That must have made a lot of companies cheap and opened up some new ideas for you. Have you made any new investments that you perhaps tell us about? Have you seen more ideas in that deep value bucket that you were talking about?
We have bought things in our deep value bucket. We've also bought things in our cyclical leaders buckets, which is really what we would prefer to do. But to start from the beginning, the coronavirus crisis has created a lot of opportunities. It has also created a lot of what investors like to call value traps, which are things that look attractive but really deserve to be as cheap as they are. And the main problem here is that leverage If you have a lot of debt, if you have a company with a lot of debt, it means that the stock price will have fallen a lot and you can probably buy it quite cheap. But whether you make money or not depends on the speed with which you get a recovery. And that's a dangerous game to play because nobody really knows how long it's going to take to get the economy back to normal. And if you get it wrong, if you try and time it too finely, if you get it wrong, your investment could turn out to be quite worthless. And so what we try and do is we just make sure that companies have staying power and have the balance sheet to remain in this uncertainty and depressed environment for long enough for our investors to play out. Now, to answer your question more directly, we have bought a lot of stocks in what could loosely be defined as a travel or holiday segment. We've bought Booking.com, for example, which is an excellent business and fell a lot because obviously nobody's booking any hotels at the moment. We've added to our position in Rolls-Royce. We had a position already. We've added to it Rolls-Royce, which makes jet engines. We've bought a position in a very similar French business called Safran, which makes jet engines for the narrow body planes, so the short haul planes, whereas Rolls-Royce makes engines for the wide body market. We've bought a position in EasyJet. We've effectively taken advantage of the fact that our opportunity set expanded substantially to make a good number of investments in companies that we think are going to, once this crisis is over, grow, produce good returns on capital, cash flow, dividends. We think we're really setting ourselves up for some years of good performance, even though in the short term, clearly our performance has been quite painful to bear.
So it sounds like you're buying sort of good companies that are in under pressure sectors, and therefore you're temporarily, while they're cheap, taking advantage of that.
Correct.
And I've also noticed that you hold a number of house builders related companies in the fund. So why do you think this area is quite so appealing at the moment?
The house builders got the share prices of the house builders fell very significantly, in many cases more than 50-60% during the coronavirus crisis, because people rightly saw that housing construction fell to complete halt. The good thing about the house builders is that they have while they close down their operations, they consume very little cash. So these guys can effectively not sell a single house for even a year, 12, 18 months even, and then just start up their operations again, and everything goes back as things were before. The risk to the house builders is that house prices consistently decline from here. And that is a risk that we have to bear in mind as investors, because house prices declining means that they lose a lot of their profitability and their pricing power. But as long as house prices stay flat or increase, which means that you're also getting a little bit of inflation protection, house builders will do quite well from here. And really they're trading on 5 times their profits or 6 times their profits at the moment. If you take a normal year, we think that makes for quite an asymmetric bet. We like it a lot. And at the same time, again, as I said earlier, the balance sheets are very strong. So we don't think we're taking a lot of downside risk.
Excellent. So moving away perhaps from the sectors and the industries to more sort of geographic locations, with your global special situations fund, you can invest all the way across the globe. So do you find that some areas are more suited to value investing than others? I'd assume somewhere like the US would be more about growth, therefore it's harder to find ideas. Is that right?
That is right. The benefit of the US, though, is that it has just a large number of stocks. And so whereas the overall market is quite expensive, the certain sectors are actually very attractive. As we were mentioning earlier, Booking.com is the US listed business. We own American Express, that's a US listed business. The cyclical meltdown that we've just been through has created opportunities in the US as well, despite the fact that it is an expensive market. Now, it is easier to find low price stocks in the UK. There are some in emerging markets. There are some in Europe. And overall, we have larger weightings. If you take our benchmark, the MSCI World, we have larger weightings to those countries than we have to the US compared to our benchmark. but we still have a big US allocation just by virtue of how many stocks are available there.
And value, though, as a strategy has been really out of favor, really, for the sort of past decade. Investors have been willing to pay for companies that can grow because it has been a very low growth world and debt is cheap. It's easy for them to expand. What do you think it's going to take for value to make a comeback, seeing as how long it has been out of favor for?
There are things that can happen which would catalyze to create a value recovery just in the style. Then that doesn't mean that value investors have to follow the style specifically, but things like rising interest rates and higher inflation, which are a possibility, would be very beneficial for what people normally consider to be value stocks. Now, it doesn't mean that as a value investor, that has to be your only avenue to invest. You don't necessarily have to bet on higher interest rates or higher inflation to look for a good result. Really, value at its core is trying to buy good business cheap. And as long as you do that, and hopefully you can disconnect yourself from what is purely the value factor. Now, I would also argue that given what the current situation is in terms of valuations, a lot of cyclical stocks are so bombed out and so depressed that all you really need for value to do well from where we stand is a normal year. And a normal year is something like 2018 or 2019, where you have low interest rates and low growth, but just a normal muddle-through economy. And you don't necessarily need a high-growth environment or high inflation or high interest rates to do well. The discrepancy in valuation between value and the rest of the market at the moment is really quite extreme. And I don't think you need any great systemic change for that to close a little bit.
Okay, and one of your colleagues pointed out, and you've probably alluded to this already, that you don't need to hold a value stock until the rest of the investment world loves it. You can make a lot of money just from that stock being really hated to it being slightly less hated. Are you seeing that at the moment?
Yes, there are moments when a lot of money is made from things going, as you put it, from really hated to just not quite as hated. The reality is that that's a very good time to buy things, but really it's very difficult to pick the moment of maximum hatred. That really is about picking the bottom, and that's actually very, very hard to do. So if you can add a few things there, like, for example, in addition to buying when things are really hated, you could try and buy good business. You can try and buy a decent management team. You can try and buy some growth, a business that actually has some future growth prospects. You're really stacking a lot of things in your favor. I mean that your hit rate over time should be higher than just an average hit rate. And now occasionally you will buy something that is absolutely hated. And actually we have done so in the hardest, most difficult days of March, when liquidity dried up and a lot of things sold off to really quite astonishing levels. We did, in one of our stocks, manage to pick the moment of absolute hatred, but I think it's quite difficult to do that consistently.
And perhaps a final question, if I may. We've talked a lot about things that could go in your favor, but at the top you talked about some of the value traps. So what exactly are you looking for to avoid those companies that have fallen? Are there any sort of sectors in particular avoiding, any countries you're avoiding, or any sort of individual company factors that you're trying to stay away from?
We don't like to dismiss anything out of hand, because the moment you start saying, "Oh, I'm never going to invest in X," you're really creating your own bias. But it is fair to say that there are some sectors that are very, very tough right now. And if you were a pure contrarian and wanting to buy the moments of maximum hatred, you would probably invest in something like retailers, landed retailers in particular, with no online offering, or you could buy something like a REIT, a real estate investment trust that owns retail properties. The reality is that then you're faced with a very real possibility of a zero. You can face total capital loss because you're buying shrinking businesses where you're hoping for some development to happen to effectively bail you out of your investment. And that might happen, but we think that is a more speculative purchase than the things that we try to buy. In terms of specific sector, I think retail is very tough at the moment, especially apparel retail. Food retail is fine because that's a different business, but apparel retail is very, very hard. And then owning retail properties, so the own retail properties are very tough business. At the moment, despite the fall, we don't think that miners are that interesting. We think that the fact that China still consumes such an enormous proportion of the world's resources means that the prices for a lot of these resources are actually higher than where they should be. But then a similar industry where we do think there are interesting things to buy is energy, where the price has fallen so low now that it really covers you for a lot of the negatives that people like to think about in energy, which is the fact that probably in 20 years' time, we're going to be consuming a lot less oil than we are today. And just the nature of the businesses is very cyclical and capital intensive. But we think the current prices compensate you for that. We think there are other sectors where the price does not compensate you for that. But to summarize, maybe just it's hard to invest in things that people call melting ice cubes. So you don't want to invest in a business that is slowly shrinking, because that just tends to go wrong over time.
Alessandro, that's been really interesting. Thank you very much for joining us today.
My pleasure. Thank you.
And thanks to you very much for listening. If you'd like to hear more from the Investing on the Go podcast by FundCalibre, please don't forget to subscribe. Please note that these are unprecedented times and the market can react very quickly to news. The views expressed are at the time of recording and could change. And remember, we've been discussing individual stocks to bring investing to life for you. It is not a recommendation to buy or sell. The fund may or may not still hold these stocks at the time of listening.